Welcome back to Talk Tickers. It is Thursday, February 5th, 2026, and today we're diving deep into the Q1 2026 print for Rockwell Automation. And I have to be honest with you right off the bat, I spent most of the morning just staring at my screen, scratching my head.
I can see why.
We have a classic earnings season paradox on our hands.
We certainly do. It's the old beat and raise that somehow, morphs into a massive sell-off. It's one of those days where if you only read the headline numbers, you'd think the champagne was popping.
Right. But if you looked at the stock price, you'd think the factory was on fire.
Exactly.
Exactly. I mean, let's look at the tape. Shares of Rockwell, ticker ROK, closed at $406.70. That is down over $23, or roughly 5.5%.
And that's the closing price? It was uglier during the day?
Oh, it was way worse. Intraday, it was ugly. At one point down about 8%, and the volume was huge. We saw 2.6 million shares trade hands compared to their usual average of around 780,000. So this wasn't just a few retail traders panicking.
No. Institutions were rushing for the exits. They were dumping it.
So our mission today is to figure out why. Because if you just glance at the press release, this looks like, a blowout quarter.
It does. You have a double-digit earnings beat. Margins are expanding at a rate that is, frankly, unheard of in this sector. On paper, this is exactly what you want to see.
So the question we need to answer is this a broken stock or is it just a broken narrative?
I think that's the right way to frame it.
Okay, let's start with those headline numbers, the beat part of the equation. Because frankly, looking at the raw data, they crushed it. Adjusted EPS came in at $2.75.
And the street consensus was what, $2.46?
$2.46. That is a massive beat, and it's up 49% year over year, almost a 50% jump in earnings.
And the top line was healthy too. Revenue hit $2.11 billion against a $2.08 billion consensus. That's up 12% year over year.
So solid growth.
Very solid. And even if you strip out currency and acquisitions, just looking at the core business organic growth was still 10%.
But the number that really jumped out at me, and I know you're going to have thoughts on this, was the profitability. Total segment operating margin hit 20.7%.
Yeah.
That is up significantly from 17.1% last year. Usually industrial giants like this fight tooth and nail just to get 50 basis points of expansion.
And they just put up over 300. It is a remarkable operational performance. Management explicitly said that sales, margins, and earnings all exceeded their own expectations.
So they even surprised themselves.
They did. If we were looking backward, this is an A-plus report card, and this is the big but, the stock market is a forward-looking machine.
It's always about what's next.
Always. And while the execution was flawless in the rearview mirror, the windshield is getting a little foggy.
Okay. We're going to get to the fog. We're going to get to why the market hated this. But I want to linger on the good for a minute because I think the magnitude of these operational wins is getting lost in the noise.
You're right. We should. When you look under the hood at the segments, the engine room of this company is firing on all cylinders.
So let's start with intelligent devices.
Okay, so this is their drives, motion control, the hardware that actually makes things move on a factory line. Organic sales there were up 16%.
Which is strong.
Very strong. But look at the profitability margins, expanded 240 basis points to 17.3%. They cited really strong performance specifically in drives and motion control.
That's impressive. But the real star of the show, the absolute jaw-dropper for me, was the software and control segment. Listen to this. Organic sales up 17%. Which is great.
But the margins?
Margins in this segment exploded to 31.2%. That is up 610 basis points year over year. That is a massive leap.
That right there, that 31% margin, that is the absolute magic of operating leverage.
Which is the holy grail for these industrial giants, right?
It is. And for anyone who doesn't spend their days staring at spreadsheets, let's just unpack that term. Think of it this way. The cost to develop and sell that software, the R&D, the platform, it's largely fixed.
Right. You pay the engineers whether you sell one license or a million.
Exactly. So every additional dollar of revenue from a new subscription doesn't come with a lot of extra cost. It drops almost purely into profit, unlike selling a physical motor where you have to buy more steel, more copper.
More shipping for every single unit.
Precisely. With hardware, your costs go up as your sales go up. With software, your costs stay relatively flat while your sales zoom. That's how you get to over 31%. It's pure efficiency.
And the key driver there was Logix.
Sales in North America were up over 25%.
And just to clarify for those listening, Logix is their flagship controller platform. It's basically the brain of the factory.
It is. And if Logix is growing 25% in North America, that tells you factories are getting smarter, faster, It also tells you that the factory of the future thesis isn't dead.
Not at all.
They highlighted the new L9 controller is off to a strong start, and they're seeing momentum in Emulate 3D, which is their digital twin software. It validates the whole strategy.
So they're selling the intelligence layer, not just the hardware.
Exactly. And speaking of intelligence, they dropped some interesting customer wins that I think paint a picture of where this tech is actually going.
Yeah, this isn't just abstract automation.
No, it's very tangible. Take Plex, their smart manufacturing platform. They said Plex had its strongest quarter yet. They landed a win with R.H. Shepherd, a commercial vehicle supplier.
And then there was the Thermo Fisher deal. I thought this was fascinating. They selected Rockwell for an AI-enabled troubleshooting agent.
And this is where my ears perked up, because everyone talks about AI, but usually it's just fluff. Management used a very specific term, agentic AI.
Agentic AI. Okay, break that down. What makes an AI agentic versus just a really smart chatbot?
Think of it this way. A standard chatbot tells you, hey, the conveyor belt motor is overheating. That's useful, but you still have to go do something.
That's just an alarm.
An agent says the motor is overheating, so I automatically slowed down the line speed by 10% to prevent a burnout, and I've already scheduled a maintenance ticket for the night shift.
Wow. It takes action. It doesn't just report, it fixes.
Exactly. It acts. That's the agentic part. It's moving from chatting with data to acting on data.
Which is massive because in these factories, downtime costs thousands of dollars a minute. If the AI saves you 10 minutes of downtime, it just paid for itself for the year.
Precisely, and that's why Thermo Fisher is buying it. It's not about writing poetry, it's about keeping the line running. They also mentioned PFM Group in Italy, FS Bioenergia in Brazil. It shows the breadth.
Right, it's not just one industry.
And one more operational point before we get to the bad news, the supply chain. Remember how much time we spent in 2024 talking about destocking?
Ugh, I try to forget, honestly. It was a nightmare. Every single call.
Well, it sounds like we can finally close the book on that. Management said distributor inventory levels are back to normal. The destocking conversation is effectively over.
Which is great news. It means the sales numbers we are seeing now represent true end market demand. Okay, hold on. I'm looking at these notes and I feel like I'm taking crazy pills. We just listed 5 minutes of absolute victories.
Right.
Record margins, supply chain fixed, software booming, AI that actually works.
It sounds perfect.
It sounds like a stock that should be up 10%.
Right.
But I look at the screen and it's a bloodbath. It's down 5.5%.
Yeah.
So you have to explain this to me. What is the market seeing that the headline numbers are hiding?
It comes down to the guidance disconnect. It's the classic, what are you going to do for me in 6 months problem.
The forward guidance.
The guidance. And this is where we have to put our skeptic hats on, because technically, management raised their full-year adjusted EPS guidance.
Right, they brought the low end up. So the range is now $11.40 to $12.20. A raise is good, isn't it?
Usually. But the midpoint of that new range is roughly $11.80. The problem is, the street consensus, what all the analysts were already modeling, was sitting around $12.02.
Ah, so they raised their guide, but they raised it to a level that was still below what the market was expecting.
The classic, we raised, but not enough to satisfy your optimism. The market was priced for a blowout guide, and they got a prudent guide.
And it gets worse when you look at the revenue side, right?
It does. They kept the sales guidance flat, still expecting 3% to 7% growth for the full year. Now, do the math with me. If you just crushed Q1 with 12% growth.
And you keep the full year at 3 to 7%. Wait, that means the second half of the year has to fall off a cliff.
Exactly. The math forces you to assume a deceleration. So they basically told the market, we had a great Q1, but don't get used to it.
Why? Why would they be so conscious if things are so good?
That brings us to the macro caution. CEO Blake Mora used the word prudent multiple times. He was very clear. While products, the short cycle stuff, are selling well, the large CapEx projects are still on hold.
The mega project pause.
Precisely. We're talking new EV plants, battery factories, chip fabs. They're being delayed, and the reasons are familiar. Trade volatility, geopolitical tension.
Right. If you are a CEO planning a billion-dollar factory and you don't know what the tariff situation is going to be in 6 months, you just wait.
You pause. You don't pour concrete until you know the rules of the game. And speaking of tariffs, management explicitly flagged a 30 basis point drag on margins from tariffs. That's a real cost.
So the big checks just aren't being written.
Not for new buildings, Automotive is growing mid-single digits, which is okay, but the major greenfield investments are on hold while they figure out the EV versus hybrid mix.
And semis?
Down year over year. Tough comp, but still, it's not the massive tailwind it was 2 years ago.
Okay, now before we move on, I have to ask about the dirty secret of the earnings beat.
Yeah.
There was something in the notes about taxes.
Right. This is the kind of detail that matters to the algos. Q1 benefited from a significantly lower tax rate, 17% versus the expected 20%. That was largely due to stock option exercises.
So employees exercising options lowered the corporate tax bill.
Correct. And that contributed about 9 cents to the earnings beat. So if you strip that out, the operational beat was a bit smaller than the headline suggests. It's not a crime, but it gives the GERS ammunition.
They can say the quality of the beat wasn't as high as it looked.
That's the argument.
Okay, let's zoom out. Because despite the drop, the strategic shift seems to be working. ARR, annual recurring revenue, is up 7%.
This is so critical for the long-term valuation. Industrial companies want to be treated like software companies. Shifting the mix toward recurring revenue is the only way to get there.
And even with the stock drop, the factory of the future thesis seems intact. I mean, e-commerce and warehouse automation grew over 60% in the quarter.
60%. That is a staggering number. That's the Amazon effect. It tells you that labor shortages are still forcing companies to automate logistics regardless of what the broader economy is doing.
There's also this weird gap, right? Industrial production data looks okay, but actual orders haven't really been unleashed.
That's the divergence. The economic data says go, but the boardroom confidence says, wait, we're in this air pocket.
We should also briefly mention Sensia, the joint venture they are dissolving.
Right. That's on track for April 1st. It's going to reduce sales by about $250 million, but, and this is key, it should improve the total company margin by 50 basis points once it's done.
So it's addition by subtraction.
Exactly. Getting rid of a lower margin, volatile business to focus on the high margin core.
And finally, valuation. The stock was near a 52-week high going into this print.
It was priced for perfection. And when you're trading at those levels, good isn't good enough. You need perfect. And a guidance midpoint below consensus is not perfect.
All right, let's shift gears. We've looked at the numbers, we've looked at the macro, we've dissected the why. Now it's time for our This Is Not Financial Advice segment.
Disclaimer time. We're not financial advisors. Do not do what we say. We're just two voices on a podcast.
Exactly. But if we were sitting in a hedge fund pod right now, pitching a trade to the investment committee based on this print, what's the play?
I'm calling this the margin arb spread trade. Or maybe the brains over brawn trade.
Okay, I'm listening. Brains over brawn. Break it down.
So here is the setup. The market is panicking about top-line deceleration. They are worried revenue is going to slow down because no one is building new factories. That's the panic.
Right. No new walls going up.
But look at the bottom line. Software and control margins are at 31%. Incremental margins ran at 50% in Q1. They are becoming incredibly efficient.
Okay, so what's the trade?
You go long Rockwell Automation, you buy the dip, you're buying that margin expansion and the software transition. You are betting that even if companies are scared to build new factories, they have no choice but to make their old factories more efficient.
Because labor is expensive and scarce.
Exactly. If I can't build a new plant, I have to squeeze every ounce of productivity out of the one I have. That requires Rockwell software.
So Rockwell wins on efficiency, regardless of physical expansion, and the short side.
You find the dumb iron. You short a pure play construction engineering firm. Find a company that relies solely on those stalled mega projects, the ones digging the holes and pouring the concrete, but lacks the software margin cushion that Rockwell have.
I see the logic. If the EV battery plant gets delayed, the construction company has nothing to fall back on. They don't have a recurring software subscription to save their quarter.
They are purely cyclical, so you short the concrete pours and you go long the automation software. It's a hedge against macro uncertainty while betting on the secular trend of technology.
That's actually a pretty compelling pitch. The robots get installed even if the walls aren't built. I like that.
It's a way to play the efficiency theme without betting on a massive CapEx boom that might not happen this year.
So to recap today's print, Rockwell beat the numbers, they absolutely crushed the margins, but they failed to comfort the market on future growth rates.
It's a classic case of execution versus expectation. The company is executing better than they ever have, but the expectations for the macro environment are getting heavier.
And it leaves us with a final thought for you to chew on. Is the factory to the future actually delayed, or is it just getting more efficient with less hardware?
That is the multi-billion-dollar question. If Rockwell can expand margins while revenue flattens, maybe the future of manufacturing isn't about building more plants, but about running the ones we have with radical efficiency.
And that's true.
If that link between building new factories and Rockwell making money is breaking, then this stock is mispriced after today's drop.
Something to think about. As always, nothing we discussed here is financial advice. Do your own research, check the charts, and read the transcripts.
Talk Tickers signing off.
Catch you next time.